Hello and welcome to Talking Points. I'm Dave Kelly, Director of Advanced Media Production at Cal State Long Beach. Today we're going to talk about what's going on in China between the trade war, economic development, and recent civil disobedience and unrest in Hong Kong. My guest today is Dr. Jack Hao. Dr. Hao is a professor of economics and he is also a China expert. Welcome back, Jack, and you've become a regular contributor here at Talking Points, so we're glad to have you again.
My pleasure, my pleasure.
Well, let's go ahead and start by talking about this ongoing trade conflict that we have with China. It's been going on for over a year now, and it seems like both sides have dug in their heels a bit. Every now and then we hear that there's a breakthrough, and there may be a breakthrough in the offing, but in the past when that's happened, something always happens and one side or the other backs out. So from your perspective or your point of view, what is at the heart of this trade dispute? What are the issues? And given what those issues are, is it likely that this will be resolved anytime soon?
Personally, I don't think having a short-term solution is not possible in the near future. The bottom line, the core issue is about market access, or what President Trump kept saying, it's an unfair, unequal trade. In terms of the market access, we are talking in terms of capital market, financial market, that's where the strength of the US is, and of course, intellectual property right issue. And if you talk about unfairness, if you may, in the US, we can access all of the major Chinese internet platforms, but if you are in China, you cannot access the major platforms that the US are strong at, for example, Google, Facebook, etc. Though we tend to focus on the goods trade, but that is actually not the core issue.
But speaking of the balance of trade with goods manufacturing, that's something we should take a look at right now. And we've got several slides, about 3 slides I want to put up on the screen to show the viewers what we're talking about. The U.S. balance of trade deficit on the first slide shows that China makes up about 47% of that balance of trade deficit, which is the lion's share. And then the next closest is Germany, which is about just over 10%. Third place is Japan with just over 9%. Mexico comes in fourth at about 7.5%, and then Canada rounds out the top 5 at about 5% of our trade deficit. But that is certainly a huge percentage of the trade deficit. Now, this is based on 2014 numbers, but we can see where the trend has been over the years. If we go to the next slide, we can see the U.S. trade balance with China, and as you were saying, it is all about the manufactured goods. We see a red line there that's going south, and that's because we're below zero on the balance of trade, and so that's a negative number. We see that in 2003, the U.S. had about $125 billion manufactured goods trade deficit with China. That continued to go into the negative, and then by 2017, we were at $375 billion in trade deficit with manufactured goods, which means over a 14-year period, there was a 3-fold growth in that manufactured goods trade deficit. When we go to the third slide, we can see what the impact of that has been on the U.S. manufacturing sector. In the bilateral goods trade deficit, we're now showing that red line that we saw in the previous graphic going north as a positive because we start at zero and go up. And there's the $375 billion in manufactured goods deficit on the red line, and that crosses the green line, which is U.S. manufacturing employment. And as you can see from the chart, we went from about 17 or more than 17 million jobs in manufacturing in 1990, and then by 2017 we were down to about 12.5. That means we lost about 5 million manufacturing jobs in the U.S. based on manufactured goods being imported from China. So Jack, I want to get your reaction to all of this. What do all these numbers mean?
Well, first of all, if you look at the pie chart of the first slide, we look at the the trade deficit. It's actually much worse now. Dave, you mentioned the $375 billion. That was 2017. 2018, it grew to $425 billion. So that's another 10% increase. So if you look at it now, that picture is even worse. If you look at the jobs, you made a very strong point in terms of the job loss. But if you look at the slide, we have a vertical line that states the time China joined the WTO. By the way, with strong US backing. And if you look at that as a starting point until about 2010, our manufacturing cost us, China potentially cost us upwards of 4 million jobs. So things are actually, if you focus on where the trade has worsened, it's a lot worse than some of the slides actually show.
Okay, well, let's move along and talk about where we stand now with one of the initiatives by China, which could potentially, cause some real problems down the line, and that is the economic goal of Made in China 2025. What does Made in China 2025 mean? What's that all about, and how could that be a problem down the road?
The Made in China 2025, on the surface, it is a legitimate, ordinary industrialization plan for any developing economy. But if you look at the details, we don't have time to go into the details, of course, but in the nutshell, in the core, it states by 2020, manufacturing goods in China, the core content needs to be 40% Chinese made. And then by 2025, that core content needs to be 70%. Remember, this is overall manufacturing, not t-shirts, stuffed animal for Disney. This includes pharmaceutical, high-tech, robotics. And here, I think, lies the core issue. If a country can have high-tech industries, 70% of the content is self-made, then we have to question, are you really a poor, underdeveloped country? Only then are you deserving of the protection that WTO affords such country. To some extent, China is like someone with a house in Beverly Hills and also wants food stamps. You cannot have both. I think that is the straw that broke the camel's back, if you may.
And so they can't have their cake and eat it too.
Exactly.
Essentially. Okay, and so if we talk about China and their economic development, we can see that they're stuck in what's called the middle income trap. And so we have another slide that's going to indicate what the middle income trap is all about. So let's bring that slide up. And we can see there, this slide does not happen to have China listed, but it shows examples of other countries that have struggled to break out of that middle income trap. And we see that, well, we should define what the middle income is. Middle income is when your country averages about $10,000 a year per capita GDP. And in the US, we average about $65,000 a year GDP per capita. And so that being the case, you look at these other countries, Japan was one that was able to break out of that low income or middle income trap in the 1960s. You can see that with the blue line at the top. There's a green line below that that represents South Korea. They were able to break out of that low income and middle income trap in the 1980s, so about 20 years later. There's a little yellow line there that represents Iran that was on their way in the 1970s under the Shah of Iran, but something happened. What happened to Iran there?
Well, for Iran, their economic reform, open of the market, was quite successful. But as we all know, the government was overly corrupt, high income inequality, causing the people to be dissatisfied. There was a revolution, welcoming back the exiled religious leader, Khomeini. And of course, the rest is history. But this demonstrates open market is the key to success, but corruption can be the Achilles heel.
And if we talk about the middle income trap for China, China's at about $11,000 a year per capita GDP. And again, we're at $65,000 per person income average per year, so GDP. So what is the problem with China being able to break out of that middle income? In order to break out of the middle income, they have to get to $20,000 a year GDP per capita. So if they're stuck at 11,000, how come they can't make that jump or get over that hurdle up to 20,000 a year?
Personally, I believe it is in their political and economic institution. That is the issue. A lot of countries can quickly reach or approach the middle income trap simply by utilizing their idle resources. But once you've mobilized these resources, you reach a natural barrier. Then you need to have the wisdom of your leadership, which not only needs to have foresight, but also not as corrupt to hinder further development. And you need institution reforms socially, politically, and economically to break through. And that is often easier said than done. And to a lot of countries that we see that are struggling with this is because of the leadership and whether they have the wisdom and the cleanness, if we may, not being hijacked by wealthy special interest groups to allow them to make the institution reform that is needed for the breakthrough.
So they have a lot of work to do in China, bottom line. So there's a lot to do there to be able to break out of that middle income trap. Let's go back to the trade war for a moment, because I want to talk about the propaganda war that goes on at the same time. We know how the press works in the United States, but we in the US don't always understand how things work in China. So one would assume that the news in China, which is probably all propaganda, is that it's all the US's fault. It's all Trump's fault. President Trump is the problem. Is that true? And how pervasive is that propaganda in China?
It is definitely true. I've been in China quite a few times. And while I'm in China, when I stay at the university hotel, I usually don't even watch the news because I have no access to CNN, BBC. All I have is the Chinese television. So I do look at it occasionally, and sometimes at breakfast they have it in the dining hall. But they talk about the unreasonable, how unreasonable the U.S. is, how unreasonable, how bullying Trump is, and they claim, and this is where you mentioned the propaganda, they claim that Japan, Canada, Europe will abandon Trump and side with China. Together, they are going to fight the bullying of the United States. And because this is state-controlled media, the intellectual people probably can see through it. But you have to understand, a lot of the general public, especially the less educated public in the rural area, they listen to this religiously. And that is an issue.
That could be a problem. We need to go to the break right now. When we come back from the break, we'll talk about more of China's economic development, the Belt and Road Project update, and we'll talk about unrest and civil disobedience in Hong Kong. Stay tuned.
Should your company buy or sell, expand or not, relocate, or simply stay the same? If you'd like to examine past and present predictions, integrating finances and people, and make future predictions based on all that information, a career in economics is for you. You can become a part of this exciting field with a degree from Cal State Long Beach.
Welcome back to Talking Points. I'm Dave Kelly. My guest today is Dr. Jack Howe, and we're talking about China. Jack, before we left, we were talking about how the trade war has played out so far. One of the things that we need to talk about and connect the dots here a little bit about what we were saying about GDP, average GDP per person per capita, and purchasing power parity, as they call it. You know, when people look at the U.S. economy, they look at the China economy, they say China's growing. The amount of dollars they're generating, the revenue they're collecting is growing. U.S. is still number one with 21.4 trillion annual GDP. China is second now in the world at 15.5 trillion GDP. And that sounds great, but actually, if you look at the average GDP, we're at 65,000 per person, as we mentioned earlier. China's still at 11,000 per person. That's 500% larger GDP. Our gross GDP is 38% larger, which they could easily overtake at some point. But it's that, middle income trap that we talked about that's hard for them to overcome. So if we connect the dots here, it's really about how the people live, the people on the street, the average citizen, how do they live? Is that what's most important when we look at economic growth and economic development?
Most certainly, it's the per capita GDP. If you look at it, we are the largest economy by GDP, but if you adjust for price differentials, there are many things in China that are much, much, much cheaper than the US. If you take into account the price difference, China's what we call PPP, purchasing power parity, GDP, China actually surpassed the US around 2014, 2015. If you look at another measure we often talk about is GDP growth rate, China's GDP growth rate has dropped to about 16% compared to about 14% before the subprime. This is part of China's problem, but that's for another day. Push comes to shove, the ultimate is per capita GDP. That measures standard of living and such. China's per capita GDP is 11,000, but if you do the PPP adjustment, they're closer to 16, 17,000. Even with that, it is still far, far behind the US.
Okay, and so with that, we need to move on and talk about what's happening with exports from the US. We export a certain percentage of goods, a percent of our export total goes to China, and they have their total coming to us. What are those numbers and what's the difference?
This is a very key issue because if we look at these numbers, this illustrates how the two countries, how much do they depend on the other side. China accounts for, based on 2017 numbers, China accounts for only 8% of total US exports. But the US accounts for over 18%, 2017, about 18.2% of China's total export. What is interesting, and most people don't know that, especially for Chinese, that Hong Kong accounts for the second largest share, over 13, close to 14%. Remember, Hong Kong is a city of 7 million. There is no way they need this amount of imports from China. So it is quite obvious the bulk of it is still coming to the US as a way to bypass US taxes, especially the anti-dumping penalties. If you look at it that way, China's dependency on the US can be upwards of 30% or more, compared to the US depends on China for only 8%.
That means that obviously the trade war potentially hurts China a lot worse than it hurts the US. Is that what I'm hearing?
Exactly.
Okay, and now that we have the unrest, the civil disobedience in Hong Kong, what is the potential impact of that on China?
It's economically, there is minimal impact at all. Hong Kong, actually, its economy depends a lot on Chinese, let's use the word tourists, that often come in the morning, they cross the border in the morning, do shopping, and then leave in the afternoon. They buy a lot of things and a lot of high-end things like jewelry and such. So with this civil disobedience, of course, that will have a negative impact. But it is more of a political issue, and I've been watching this closely, and I keep wondering and debating with myself whether China should intervene or not. If we put ourselves in China's position, China is really in a tough place. They have let it go on for 4 months now, and it's getting worse. Police are getting hurt, stores are being vandalized, and this is spreading. But if China intervenes, the world will have damnation. So I really think this is something that China, I sympathize that they are really in a rock and a hard place. But in terms of pure economically, it does not affect China that much.
Okay, and as far as what's going on in the rest of the world, because the world keeps moving forward, even as this conflict exists between the U.S. and China, what we've seen is that China is no longer the lowest wage place where you can do manufacturing anymore. Other areas are now offering lower wages to their workers and are taking up some of that manufacturing. So, for example, Vietnam, Cambodia, Thailand, even Burma, which is now called Myanmar, they can manufacture goods more cheaply than they can in China. So how is this affecting China, being that they're so close to those areas, particularly Vietnam? Is China taking advantage of this in some way?
We see a lot of Chinese firms investing in a lot of these countries. China, since about 4 or 5 years ago, there has been a national policy from the central government to encourage what we call OFDI, outward foreign direct investment, encouraging Chinese firms to invest outwards. In 2015, I think, China's outward foreign investment was bigger than the inward foreign investment, so that is a milestone. China's wage is a lot higher than it used to. Forbes had an article a couple of years ago showing China's wage has long surpassed all of its southeastern neighbors, including Malaysia, which has the highest income wage. It is now approaching quite a few of the new EU members. But of course, China is part of the 2015 is to have the industrial upgrade, so they move away from the labor-intensive manufacturing to more technology, capital-intensive. And even for the labor-intensive, you see China moving towards robotics to replace labor.
So automation is in their future as well.
Yes.
Well, let's talk about Vietnam specifically, because Vietnam, there's an interesting chart I want to take a look at, so we'll put that on the screen right now. We have a chart here that shows Vietnam's imports from China. That's the red line on that bar chart. So if you look at that red line, you see that that is pretty large compared to the other red lines that you see on that graph. And then if you look at the blue line, that's Vietnam's exports to the U.S. Now, if one puts 2 and 2 together, they can see that, something happened recently where Vietnam all of a sudden was importing a lot of goods from China and at the same time exporting a lot more goods to the U.S. So that means Vietnam is serving as a pass-through for China's goods?
I personally believe that's absolutely the case. This is from January to May of this year compared to the same period in 2018. In other words, this is a very clear example of the effect of President Trump's tariff. To bypass that, Chinese firms are exporting their goods to Vietnam, relabeling it, and exporting it to the U.S. through Vietnam. And that is why a couple of months ago, the U.S. also slapped a tariff on Vietnam. I've talked to some of my Chinese friends, and they are saying they are now looking at Cambodia. In other words, we shouldn't be surprised down the road, Cambodia will be country number 2 that the U.S. will slap a tariff on. And of course, they will now move down the domino to the next country.
Okay, so let's go to the next slide that actually talks about the trade balance with the U.S. and some deficiency in terms of where the money is going in China. Now, a lot of people have said we're making a lot of money, or China is making a lot of money selling goods to the U.S. We've made them rich. I've heard that said. But at the same time, they're not holding on to all of that money. If we look at that chart, we can see that the positive side, the trade balance with the U.S. is represented on the figures that show things on the upswing. But if you go below the line, below zero, that's where the money is going out of China. So what does this mean if money is going out of China? Is their current balance now dropping significantly?
Yes, if you look at the top panel, the upper half of the top panel represents the goods trade balance. And if you look at it, it's about 400 billion. And recall, the U.S. trade deficit with China in 2017, it was 375. In 2018, it was 425 billion. In other words, China's trade surplus is almost exclusively with the US. And of course, that is where the beef is, so to speak. But if you look at the bottom half, the darker portion, the dark blue portion of the upper panel, that is the trade of services. And you can see China is losing money. It's a deficit, meaning money is leaving China, and that is growing. There are several components of this, and I think the two largest is tourism. There is a lot of Chinese tourism, and a lot of our high-end stores in Los Angeles depend heavily on Chinese tourists. And I think our audience, if you go to Nordstrom's, if you go to some Saks, Neiman Marcus, you will see a lot of Chinese languaged advertisement that tells you where the beef is. And also another big portion is students. Students, their tuition, their books, their expenditure, and such. So if you look at the solid line, that's the combined of the two, what we call the current account balance, and you can see China is doing worse and worse. And according to World Organization estimates, in the next couple of years, China could drop to be a deficit overall. And of course, that is one of the reasons why China is fighting us fiercely on this issue.
Okay, Jack, we've almost run out of time, and we know that China is having difficulties because of the trade war. They have difficulties anyway, so they've got some work to do. One last question, very quickly, the Belt and Road Project. We talked about it in a previous show. What's the update in about 30 seconds of what's happening with Belt and Road?
China has toned down its Belt and Road initiative. Originally, they called it the Belt and Road Strategy, but they found a lot of backlash, so it is now Belt and Road Initiative, and there has been quite a few celebrated failures, so China is now more cautious. But if you look at the previous slide that we discussed in the lower panel, it shows the statistical discrepancy. Theoretically, that should add up to zero. But if you look at the last 4 or 5 years, China has had an average of 200 billion outflow of money. Part of it is the Belt Road losses or Belt Road investment that is kept in the dark. And of course, part of it is hot money leaving China to evade the anti-corruption laws.
Right. And unfortunately, we've run out of time, but I want to thank you for being here today, Jack, and sharing all of this important information with us.
My pleasure.
And thank you for joining us on this edition of Talking Points. Be sure to join us again soon for another episode. Until then, I'm Dave Kelly. Have a nice day.